Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Joyce, managing director on Nasdaq's Market Intelligence Desk, for an update on technical levels to watch in the Nasdaq 100. We'll also take a look at some other areas in the market that are feeling the heat from some things around the consumer, rates, what Powell had to say today. Brian, it's great to see you as always. Welcome back to Trade Talks. And before we get into other areas of the market, let's get a quick review of the technicals on the Nasdaq 100.
You're absolutely stand by. Yeah, so we're seeing some broad weakness across the marketplace today, and it really led to the downside by small caps. So the Nasdaq 100 right here, you can see it's still range bound. It's been range bound since the high back in July, but we do have this trend of lower highs clearly in place. We kind of peaked last Thursday right at this trend line that connected the prior two tops from July and back in late August. So we're now returning to the bottom of the support zone, which is right around 14,650, 690 or so. And so that will be the key level if we continue to trend down towards there to watch for potential support. We're back down below the 50-day moving average, which recently has been beginning to trend a little bit lower. So that's something to keep an eye on. 200-day is down at the 13,826 level. So for the Nasdaq 100, it still continues to be sideways consolidation, still up 35% on a year-to-date basis. We are higher on the month as well. We're the only major index in the United States at the broad level, the most broad level that it looks at all sectors. That's up month to date. Despite the challenging environment in certain groups, down quite a bit, the Nasdaq 100 is still holding in.
Well, Brian, let's switch gears a bit and talk about small caps for a moment here. We know they are especially interest rate sensitive. Of course, they don't have that cash flow that some, that larger mega cap companies do. So for them to acquire financing and to service their debt, it's a big challenge for them, and clearly that impacts their balance sheets. What are you seeing in terms of the small cap space from a technical perspective?
Yeah, so certainly these smaller caps, whether it's the Russell 2000 small cap index or the smaller micro cap index, definitely a challenging environment. You can see the Russell 2000 right here. It's breaking the lows that's been in place for all of 2023. This week, it's just beginning to break those lows. So if we close around here, it'll be the lowest weekly close of the year, just below 1 or 2% down, maybe slightly more than that at the 1,640 level. Are the lows from 2022. So if we're trending down towards there, then that would be something that would be from a technical perspective, an expected support level. We want to see that hold if you're constructive on the markets. If we dip down to the Russell microcap index, we can see they've already broken their lows from the last 12 months, weeks ago, back in early, I should say mid to late September, the week of September 22nd. They broke that key level, which represented the lows in April and May, and back in the mid part of 2022, and as well as Q4 22. So that clearly defined support line for the microcaps is well broken. And if, I don't know if this is a, canary in the coal mine leading indicator from a market perspective for what we're going to see with the Russell 2000, hopefully not. But, certainly for this space, they're seeing, a significant break last month in that support level going back to mid-2022.
All right, Brian, let's wrap up and talk about the consumer for a moment here. I mean, for the past 18 months, everyone's been betting, against the consumer, higher interest rates. We know student loans are coming back online. I think repayments resumed this week. We know they've exhausted their COVID savings and so forth, but they continue to keep this economy propped up. I mean, we saw it in the latest consumer spend data earlier this week, but I think Tesla could have potentially spooked that, and we saw that in the consumer sector today. We saw it in the home building sector today, where, I believe some of the comments around it were the higher interest rates, it's going to be harder for consumers and discretionary spend.
Yeah, as you noted on Tuesday, we had the strong, robust retail sales data, and so I think that caught many off guard, given, as you noted, the higher rates. I have plenty of charts on the rates and spreads and the curve. We've seen a phenomenal move higher today. In the 10-year yield, we hit 4.99%. But, it's something to keep in mind because, this week, the 30-year fixed mortgage rate hit 8%. And so when you look at, say, home builders, certainly rate sensitive, we could see in the last couple of days, they made a convincing break below their 200-day moving average. So this is one of the top performing industries since the 22 lows, up over 86% at the July high from last year's bottom. And we're now giving back about 18 to 19% and breaking a key support level at that 200-day. Regional banks recently on Tuesday, they had a nice rebound higher, but they stalled right at this price gap that goes all the way back to Q2 earnings season in mid-July. And so we had that gap level was, to me, important because it was support back in August. It was support again back in early September. And you can see we've been bumping up against it repeatedly over the last few weeks. And so we're now beginning to reverse lower from there. And so, and then when you look at, sectors that may be, maybe less rate sensitive here, this maybe correlates more to the NASDAQ 100 to technology. This is the semiconductor ETF SMH. We can see last Thursday it peaked at this declining trend line, very similar to the NDX, and is now trending lower. So this is one of the, along with the home builders, semiconductors have been one of the top performing groups. And so we care if they're not doing well all of a sudden, and how much are they going to retrace and give back on their prior 2023 move to the upside. Because if the small caps, the micro caps are not doing well, we're seeing now corrections, deeper corrections in the top performing sectors and industries, and individual stocks. Tesla today down over 10%, warning about future growth. Then that's something that maybe would be a concern for the broader averages with when you see these bigger outperformers not doing well. That could be an indication that the future performance of the bigger indices, may see more significant headwinds.
All right, Brian, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.